before my current role, which is an in-house tax team with a US multinational. In the academic field, I have been teaching ATTS M4 as well as Singapore Foundation Program for over 10 years. With that, allow me to move on to cover our lecture proper. First off, let's go through the learning objectives. After the webinar today, I hope that the candidates will be able to at least understand the 3 key points below. 1. Recognize the tax treatment of income and allowable business expenses of a general partnership. 2. How to compute divisible profit and adjusted profit of a general partnership. 3. Explain how to allocate the adjusted profit and capital allowances to each partner. These learning objectives definitely do not represent what the topic has to offer. However, I hope that with these learning objectives in mind, it will serve as a signpost for candidates when you are looking out for what to understand and take away from this chapter, as well as to test yourself and check your understanding before the exam. In addition to going through the theory, we will also be covering one example. Thereafter, we will move to look at some of the past year exam papers, as well as the suggested solutions for those papers. Now, let's move on to the next slide. General concept of partnership. Upfront, it is important to recognize that the taxation of a partnership does not follow what the concepts you have learned so far about taxation of individuals and taxation of corporations. By now, you should have learned the basic of how to compute the taxable income of an individual and a company. If not, you should be covering it shortly, so do not worry. Coming back to the general concept of partnership, the first rule you have to remember is a general partnership is not a separate legal entity. What does this mean from a taxation perspective? It is important to note that when we refer to the point that a general partnership is not a separate legal entity, it means that the general partnership will not be taxed in its own name. In other words, it is what we call a see-through entity for tax purposes. So, does it mean that a general partnership doesn't pay tax? The answer is yes. The partnership itself does not have to pay tax. However, the same cannot be said for the partners of the partnership. The tax on the profit that the partnership derives would be imposed at the partner's level. If you recall, you will realize that there is no restriction on who can form a general partnership. In other words, a general partnership could be formed by a group of individuals, a combination of individuals and corporations, or even in a very unlikely situation, a group of corporations. So what does it mean when we translate the point taxes imposed on the partners and not tax in the name of the partnership? It simply means that from an inland revenue perspective, the IRS will not tax the partnership, but rather they expect the partnership to compute its adjusted income, divisible income, and then have those income attributable to each of the partners and have tax imposed at the level. That would also mean that in terms of how do we treat the profit received by the partners in their own respective returns, it depends on the form that the partners are in. If the partners is an individual, he will have to then report the profit in his income tax return. If the partner is a corporation, such as a private limited company, it will then have to report its profit received as part of its corporate income tax return. Let's move on to the second most important point in the general concept of a partnership. You need to recognize that there is a concept of a president partner. Most of the time, when a partnership is formed, if no specific legal or tax advice was sought, most partnerships do not aware of the fact that the first named partner in the partnership agreement will be regarded as what we call a precedent partner. This precedent partner does not actually mean they will get more return, as the profit sharing ratio of a partnership will be agreed during the negotiations and formations of a partnership. However, you do have to recognize that this precedent partner, recognized as the first name partner in the partnership agreement, will undertake certain statutory obligations under the law. We will now go through each of them. 1. The precedent partner is responsible to file Form P. If we refer to the earlier slide, a partnership does not have any obligation to file a tax return, neither is the partnership being subject to tax at the partnership level. So what is the purpose of this Form P? The purpose of the Form P is to compute and submit to IRAS what is the divisible profits that each of the partner would receive from the partnership after the financial year end. This is also an important role, as the Inland Revenue will go after the precedent partner if the Form P is not filed on a timely basis. In addition, the precedent partner will also be obligated to inform all partners of their share of income from the partnership. This is to ensure that the partners are able to declare their income in their respective returns, either in their individual income tax return for individuals or their corporate tax returns for corporations. In addition, if any of the partners would want to object to the adjusted profit computed, they would also be lodging that on behalf of the other partners. Next, should there be any changes in the composition of the partners, such as when a partner joined a partnership or a partner decided to leave the partnership, the precedent partner will have the obligation to inform IRAS of any change on a timely basis. In addition, in the event that the partner is a foreigner or non-resident for tax purposes, the precedent partner also have to give at least 1 month written notice to the IRAS before the termination of the individual or cessation of the individual's participation in the general partnership. Now, let's move on. The basis of assessment of a partnership is based on its accounting year. What do we mean by accounting year basis? If you recall, for individual income tax purposes, the individual's year of assessment will be based on a calendar year basis, meaning an individual's income derived from Jan 1st, 2023 to December 31st, 2023 would be included in its YA 2024 tax return. For companies, they do not necessarily follow a calendar year end. Rather, it depends on their accounting year. For example, a company that has its accounting year starting from 1st July 2023 to 30th June 2024 would file its YA 2025 tax return using the same assessment period. In this case, the basis of assessment for a general partnership would depend on its accounting year end, and that can be dictated by the general partnership itself. Next, we mentioned the returns of the partnership is also known as a Form P, and Form P's purpose is not to enable the partnership to be subject to taxation. It is more of informing the Inland Revenue what is the divisible profit of each partners of the partnership for the IRAS to actually subject or review these profits of those partners. Lastly, change in partnership. Whenever there is a change in partnership, the old partnership would have been deemed to have dissolved or ceased to exist, and a new partnership is formed thereon with the new partners' composition. This is important from a liability perspective because any liability incurred by the old partnership would not be transferable to the new partnership, and the old partners who have exited the partnership would not be liable for any other claims that happen after they exited the partnership. Now, what are the important key terms that you will be required to compute for taxation of a general partnership? Take a look at the slide and be familiar with these terms. The two key terms that you have to understand will be the adjusted profit of a general partnership and divisible profit of a general partnership. An adjusted profit or loss of a general partnership is computed by taking income assessed under Section 10(1)(a) of the Income Tax Act and all expenses wholly and exclusively incurred by the general partnership in the production of the taxable income may be deducted, subject to Section 14 of the Income Tax Act. Divisible profit is by itself a more simple concept. It's merely the adjusted profit less of the partner's salaries, allowances, bonuses, CPF contributions, interest on capital, and any other expenses paid on behalf of the partners. You will see that in later questions, as well as some of the past year exam questions, you will need to analyze this expense and determine if those need to be taken into consideration when computing both the adjusted profit as well as the divisible profit. To put these two terms into a formula style of explanation, the adjusted profit is simply the net profit before tax, minus of income from other sources, and adding back any non-deductible expenses. To get to divisible profit, simply use the adjusted profit less of the partner's salary, bonus, allowance, CPF, and any expenses paid on behalf. I hope these two formulas are clear. We will test your knowledge in the coming examples as well as the past year exam questions. Here, what I have shown here is one of the suggested method on how to remember where do we get divisible profit and adjusted profit. As you can see, once we get the net profit amount, less of income from other sources and non-deductible expenses, and without adjusting for any of the partner's salary, bonus, allowance, CPF, and other expenses paid on behalf, you will first come to the divisible profit. And then after, we add back the amount that would actually be the adjusted profit. Kindly note that this is one of the suggested methods to represent divisible and adjusted profit. If you can remember it in an easier manner, feel free to do so. As long as you make the right adjustment, you will come to the right answer, which I will show in the work examples shortly. Next, in addition to computing a divisible profit and adjusted profit, you will need to understand how the profits are allocated between the partners. Now, in absence of any specific call-out, you may assume that a general partnership will have all the partners share the profit equally. However, in reality, there is no mechanism or law to say that the profits must be shared equally. In fact, partners of a general partnership will typically state what is the profit allocation ratio in the partnership agreement to ensure that there is no misunderstanding or miscommunication when calculating the amount after the partnership is operational. So here we will look at how do we mathematically compute the allocation of profits among the partners. So first you need to establish what is the profit sharing ratio. In this case, I have given the profit sharing ratio to be 40:60. In some questions, they may ask you to find the profit sharing ratio by saying that the profit sharing ratio is based on their capital contribution. You should be able to use the capital contribution amount to compute it accordingly. Here, you can see that in the example, partner A and partner B enter into a profit sharing ratio of 40%:60%. Therefore, partner A will have 40% of the divisible profit As for partner B, it will be 60%. The adjusted profit that they get will be accordingly the same amount, adding back the amount that they have in terms of their salary, bonus, CPF, and other expenses paid on behalf. It will be good to note that capital allowances would also be apportioned based on the agreed profit sharing ratio. This is a very important point that it will do you well to remember during the exam. All right, we have now come to the work example. Let me go through the work example in greater details. A and B are partners in a general partnership. During the year ended 31st December 2023, their partnership made a net profit of 600,000. Included in the partnership accounts are the partners' salaries of 300,000, 150,000 each, accounting depreciation of 100,000. The capital allowance for the year of assessment 2024 worked out to be 200,000. Profit and loss is shared between A and B in the ratio based on the capital contributions made by each of them. A contributed 300,000, whilst B contributed 700,000. Required to calculate the profit allocation between A and B for the year of assessment 2024. I hope you can take some time to attempt the question before proceeding next to look at the suggested solution. For the suggested solution, the first order of business is to establish what is the agreed profit sharing ratio between the two partners. Based on the question, the agreed profit sharing ratio is based on the respective capital contributions made by each of them. A contributed 300,000, while B contributed 700,000. Therefore, in this case, the ratio should be 30 to 70. Next, what is the divisible profit? So divisible profit is basically 750,000 as we added back 150,000 of accounting depreciation to the net profit. The adjusted profit itself is 1,050,000 after considering the partner's salary of 300,000 on top of divisible profit. So finally, we present all our workings in the table format based on the requirement of the question. As you can see, this table format will allow you to go through each of the components in a clear manner and present it to the examiner to address the question. Here we have partner A, B, and total. As an internal check, you have to ensure that the number on the total side ties to the question. So divisible profit is split by the ratio of 30 to 70. Most of this should have been addressed in the earlier portion. One notable call I would like to say is that the capital allowance, the total of 200,000, is also a portion based on the profit sharing ratio. With that, you will get 60,000 for partner A and 140,000 for partner B accordingly. So is this work example considered simple? I hope so. This means you have at least gotten some basic understanding of how to compute the taxation of a general partnership. Now I will move on to give some guidance based on past year's exam questions, starting from the latest one in June 2023. Before I proceed, I would like to provide some practical guide to how to deal with these questions that are related to taxation of general partnership. By now, you will have realized that you do need knowledge in the other topics, such as taxation of individual and taxation of companies, to help you with questions for this segment. This is because fundamentally, when we calculate the tax for a partnership, tax is imposed at the partnership level and tax is not imposed at the partnership level, but rather on the individual partners itself. Now, let's read the question. Jason Tan and Jack Paradise Group Private Limited, JPG, are partners in Tan Jiak General Partnership, TJ, which runs a chain of coffee shops in Singapore. They have agreed to share the partnership profits and losses equally. The net accounting profit of TJ for the year ended 31st October 2022 is 258,000 after crediting the following items. Receipts: interest income of 23,000 received on maturity of fixed deposit with Citibank Singapore and an approved bank in Singapore. Expenses: reimbursement of the car running expenses of 21,800 incurred by Jason on its model car SMX 103J for business 4,000 and private purposes 17,800. Reimbursement of business entertainment expenses of 7,000 incurred by Jason. Jason is paid an annual salary of 144,000, staff salary and employer CPF contribution of 1,368,000, Jason's medical insurance premium of 6,800, depreciation of kitchen and office equipment of 65,000, accounting and human resource management fees of 120,000 paid to JPG, annual contribution of 25,000 to JPG's staff welfare fund as mandated under the partnership agreement. The partnership is entitled to maximum capital allowance of 40,000. 1A. Compute the adjusted profit and divisible profit for Tan Jiak General Partnership for the year of assessment 2023 for a total of 6 marks. Before I proceed, I would like to remind the candidates that you need to read the requirements of the question carefully. In this case, you will be required to compute and present the adjusted profit and divisible profit for Tan Jiak General Partnership for a total of 6 marks. Most candidates in this situation may end up doing more than required by wandering into the realm of calculating the tax for the individual partner and the corporate partner of Tan Jiak General Partnership. This is not required for this particular question. So remember, before proceeding with the question, you need to read the requirements carefully. As you can see, we have the suggested answer presented in a table format, typical to what you would see or expect of the computation of a general partnership. In addition to setting down the partnership name, we also put down the year of assessment and basis period. For YA 2023, the basis period would be November 1st, 2021 to 31st October 2022. So alternative 1 presentation. And the reason of why it's alternative 1, this is because, as mentioned earlier, the presentation format itself may be one of the ways that you choose to present it. While it is technically a recommended table for you to present your solutions, please note that if you are able to present all the components on how you derive the adjusted profit and divisible profit for Tan Jiak General Partnership, you will be able to attain the required marks for this question. Now, I will go on to explain the answers. So starting with the net profit for the year, 258,000. This portion represents the accounting profit of the partnership, minus of interest income of 23,000, because it will be less of income of other sources, giving us an amount of 235,000. So in terms of add-backs, what do we have? We have the car-related expenses of 21,800, Jason's annual salary of 144,000, Jason's medical insurance premium of 6,800, depreciation of 65,000, and contribution to JPG for 25,000. And after adding back the amount of 262,600, we come to an adjusted profit of 497,600. Now, we move on to compute what is the divisible profit. So we less off in terms of what we call expenses related to the partners. So for example, Jason's car related running expenses of 17,800. Note why we only less off 17,800 and not 21,800. You have to be clear that the adjustment is for the amount that's attributable to Jason. We're not taking a position on whether the amount is considered deductible or non-deductible for income tax purposes. Next, we also deducted Jason's annual salary as well as his medical insurance premium, as those would be regarded as expenses specific to a partner. Last but not least, the mandated contribution to JPG of 25,000 would also be considered an expense of the partner paid on behalf. Therefore, after deducting 193,600, we end up with the divisible profit of 304,000. Take note that this question did not request for you, at least at this component, to compute the allocation on the partner's basis. Now, moving on to the next sample question. Let's go through this question, and after this, let's also discuss what are the similarities and differences between the two questions that we have just gone through. Candace Liu and Blossoms Private Limited are partners in Windsor Gardens, a general partnership which provides landscape architectural services in Singapore. They have agreed to share the partnership profits and losses equally. The net accounting profit of the partnership for the year ended 31 January 2020 is 21,000 after crediting the following items. Receipts. Interest income of 24,000 received from UOB Bank, an approved bank in Singapore. COE rebate of 15,000 on scrapping of second-hand motor car SGH2252Z during the year. The car was purchased in year 2016 at a cost of 30,000. Expenses. Loss from sale of gardening equipment of 500. The equipment was bought in December 2017 at the cost of 3,000 and sold for 1,800. The partnership has always claimed maximum accelerated capital allowances, and there were no other qualifying plant and machinery acquired during financial year 2018. Reimbursement of Candace entertainment expenses of 25,000, of which 16,000 was in respect of business entertainment. Cost of 7,800 incurred by Candace in taking part in an approved horticultural trade fair in Singapore. Candace is paid an annual salary of 105,000. Candace's husband is the office manager, and his annual salary is 72,000. The market rate for a similar position is 66,000 per annum. Depreciation of office equipment, 25,000. Interest payable of 1,500 and 8,000 to Candace and Blossoms respectively on their capital contribution. Contribution of 150,000 annually to Blossoms Staff Welfare Fund as per the partnership agreement. During the year, the partnership purchased the following plant and machinery, which were capitalized in the balance sheet. 2 sets of new gardening equipment, each costing 5,250. One of these was to replace the equipment that was disposed of during the year. See 1 under expenses. The partnership would like to elect the provisions of Section 21, an event costing 105,000. The partnership would like to continue with claiming maximum capital allowances on the accelerated basis, capital allowances on plant and machinery purchased in previous years and which are still in use. Through what are the similarities between this question and the earlier one. Take note specifically on interest income, certain type of expenses, such as Candace entertainment expenses, which has a business component and purportedly a balance that's non-business related. Also, contribution of staff welfare fund to one of the partners. These are similar points that you will need to understand and there is a likelihood that these points would also be raised in future questions. For this question, they have a two-part sub-questions that require you to, one, calculate the adjusted and divisible profits and capital allowances for Windsor Garden for YA 2021. That is worth 11 marks. 2. Compute the statutory income of Blossoms Private Limited for YA 2021, taking into consideration the following information.